Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
Now, let's jump into it. So, Anit mentioned that I have some background in statistics, and I'm going to show you some things here that people don't typically kind of float around in front of retail customers. But what the hell, we'll have a little bit of fun with it. What this is, it's we have changes in S&P 500 on the vertical, and we have changes in EUI, or changes in the foreign exchange pair on the horizontal. And this is a scatter plot. What this is trying to say is, hey, show me what is the relationship between the two. And one of the things you notice on this kind of a messy thing, and the way to read it is just to look at the overall pattern, that there is no pattern. It looks like a mess. I mean, this is what noise looks like, and this is great. This is one of the main reasons why we want to look at FX markets, is because they provide the diversification, and they provide an uncorrelated asset class for us to trade. And just as for comparison purposes, I did the same thing with like IBM versus GE, right? And what you see here is that if you kind of drive a line through this cloud, this is kind of a positive relationship between changes in price of GE and changes in price of IBM. In other words, it's saying, as GE goes up, so does IBM, and GE goes down, so does IBM. And so you don't really, even though these are very, very different companies doing very different things, you don't really get the benefit of diversifying yourself when you're holding these types of companies. And the worst thing is that you don't get the benefit at the worst possible time for you, because when everything starts going down very, very fast, the correlations actually approach 1. So everything gets very, very correlated. And this is kind of why, one of the first reasons I want to point out to you that, in currencies, we get this benefit that we get from cross-asset correlation and diversification. Okay. So, I mean, if you prefer to look at it the other way, this is a picture from how people typically look at these things in this happens to be a chart from thinkorswim platform. The top line is the S&P, the comparison line is Euro USD, and the correlation is drawn at the bottom. So there's a question that maybe other people have, so I will answer it. What is delta SPY? Delta SPY is just a change of SPY. So it's a daily change of prices in SPY. It's not an options related delta. Okay. All right. So when you look at a chart like this, you may kind of think that, hey, you know what, this could be a candidate for some sort of a pairs trade, right? I mean, there's correlations flopping around. Actually, it isn't. It's hard to see on this chart. The previous chart that showed like pretty much no correlation over time between Euro USD and SPY, and it would actually be a pretty bad candidate for pairs trade. And that's one of the things that we'll talk today. Are actually, I think more of them will be what not to do versus what to do. So for doing pairs, you generally want things that have been correlated tightly over time, and then the correlation structure breaks down somehow, and you're betting that the correlations will mean revert. So this is definitely not what you want to do when it comes to trading these types of things. Okay. So what I want to do is, because we're going to talk a lot about implied volatility, and I never know if people are, up on all of the things that we mean by implied volatility. So if it's completely clear to you, so sorry, I don't mean to insult your intelligence, but for those who may not be as familiar, let me give you a kind of a quick primer, and then we'll jump into some of the actual things that we look at on the skew and so on. So implied volatility is basically a market consensus of the expected move of the underlying, and this is where and we get that implied volatility from the price of the option. In the listed market, the price of the option is given to us by the market itself, and then we can from that price derive what the implied move is going to be. In the over-the-counter markets that are not liquid, typically the trader estimates the implied the volatility, and then plugs it into the model, and then they get a price of what that contract should be traded. In listed, it's sort of the other way around, and it is quoted in annualized one standard deviation moves. Yes, the question was what formula is used in Forex, Black-Scholes. Yeah, it is a modified Black-Scholes typically formula. The modification is the regular Black-Scholes takes on an interest rate, one interest rate, domestic interest rate, and in the Forex you have two interest rates that go into it, right? Since there's two currencies, and so there's actually two rows. If you know about the Greeks, rho is the sensitivity to changes in interest rate. There are two of those in Forex. So I'm going to walk you through an example. So for EUI, let's see what the implied volatility, the current level of implied volatility, tells us today about the expected move in EUI in 1 month, right? And let me also preface what do we mean by one standard deviation? One standard deviation in normally functioning markets just means that the events that happen 68% of the time. Why that is a long story, but just take my word for the fact that it's kind of a 68% of the time. That's what we expect to happen. So right now, the average volatility in EUI is quoted at 13%. So what I'm doing here is, because it's annualized, I have to, is the sound okay? Somebody's saying that the sound is gone? Are we okay on the sound? Fine. Okay. Sorry about that. Okay, so we need to back out from the annualized volatility into the monthly, and in order to do that, we'll just divide that by square root of 12 to get a monthly move. So I'm taking 0.13 divided by square root of 12. It's about 3.7%. And now I need to calculate the percentage move for the index. And index was the last, I think it was like 77.68. So that translates to about $2.9 move. And then finally, if we add that and subtract that to the current price, the bounds that we get. So these are the one standard deviation bounds for 1 month from now. So the options market is saying that the EUI will be somewhere between 80.5 to 74.7. Now, another way to see that, if there are platforms out there that will actually do this calculation for you, if you're lazy like me, I don't usually just calculate this by hand. So this one also comes from Thinkorswim's chart that actually draws the probability of expiration cone. So if you look at it, EUI right now at 77. In fact, if you look at the 9/17, which is about a month from now, it tells us that EUI will be between somewhere 80 and 74, which was pretty close to what we've calculated by hand.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.